back. You're watching Wealth Manager. Structured products are back in vogue among HNIs. But does this investment avenue make sense for you? I'm joined by Feroze Azeez, Deputy CEO, Anand Rathi Wealth Management. Thanks very much, Feroze, for joining me. So let me start by asking you that, during and even after the 2008 recession, we saw structured products really losing favor among investors. But that seems to be changing now in the past couple of years.
Yeah, absolutely. Structured products have come back into the HNI's interest arena because there has been a lot of good performance delivered by structured products over the last 5-6 years, post the 2008.
Right.
Actually, yeah, I think that's become the prime reason why today an HNI looks at a structured product to actually be a part of the portfolio. Some HNIs actually consider it as a 30-40% of their portfolios are into structured products.
Okay. So what are the kind of structured products that are available today, and any change in their structure really, whether it's in terms of the risks that one has to face, whether it's in terms of the chart structure or the investments at all?
See, for the first bit of classifying them, there are two kinds, and from a risk perspective, there are two kinds. One is the principal protected structured product and a non-principal protected structured product. The principal protected structured products, come what may in terms of the market movement downwards, you still get back your capital, which does not happen in an equity mutual fund, for example. None of the mutual funds actually guarantee a principal.
Right.
Of course, the certainty of getting back a principal in liquid fund would be significantly more. So these are the two basic categories in which a structured product can be classified. Of course, then moving on to the next question, which is a charge structure. See, charge, it's become more competitive, so the charges have actually come down in terms of the upfront fees, which you need to pay to buy a structured product. Used to be 1% per annum, so a 3-year structured product used to cost you about 3%. Now it's come down to about 1.5% or 2%.
Feroze, given that these products are quite layered and complex really, what are the risks that one really needs to be aware about?
See, very, very importantly, there are two risks. One is your view on the market not going correct, and the other is the issuer risk.
Right.
The person who gives you the promissory note or the debenture or the structured product should be able to live up to the promise and should be solvent at the end of the tenure of the product. For example, if you bought an ex-corporate structured product, the corporate needs to be solvent at the maturity date. So, but the good part is most of the structured products are called secured debentures, which actually brings a trustee in place. And that guy actually tries to hold the interest of the bondholders and trustee. So the most important thing to check is whether your structured product is secured or unsecured from a lending perspective. That's the most important thing. And then making sure that your structured product has not a very high expectation from the market, having a mediocre expectation from the market. If your product is going to do well, if the market actually gives you 25% CAGR per annum, then that's too much to expect from the markets. So make products and actually buy products which have a very limited expectation from the market, because in structured products you can make a product which says market will go up 5% an annum, which is a very, very bare minimum thing, but the product can deliver you 15-17% per annum. So those are the products what you need to choose to mitigate the market risk. And the other is make sure that you're buying a secured structured product which brings down the credit risk of the issuer in the structured product which you buy.
Right. So how does structured products really fit into one's portfolio? I mean, you said some people opt for 30-40% allocation, but ideally how much should one allocate as well?
I think 30% is a very good number to have in structured products, because what happens is
30% of your equity portfolio,
of your overall portfolio. The debt portion also should have some structured products. The principal protected ones fit into the debt category, and the ones which are non-principal protected should be fit into the equity category. So you split your money. If you, let's assume there's 30%, one puts 15% a debt kind of principal protected structure, 15% into a non-principal protected structure, and allocates them into debt and equity respectively. So that should be, I think 30% is a good number.
So what about the kind of returns that one gets from these products if you were to compare them with other investment avenues?
See, what happens is, I'd say on the debt category, if you analyze the last 100 products matured, I would say about 13 to 15% on the debt category with principal protection or a high degree of safety is possible. On the aggressive category, which actually take risk on your principal in case the markets actually take a U-turn, those products have been able to deliver 18 to 20%. So they have been able to generate alphas over and above mutual funds over the last 5-7 years.
So how does one really decide on which structured product to opt for? Because, I mean, of course, we do have various issuers in the market today.
Correct. So there are a lot of issuers in the marketplace. So make sure that you buy a structured product from a person who is offering a secured structured product.
Okay.
See, in my opinion, ratings of structured products is not very critical.
Right.
Unlike buying a bond, where you buy a bond, you're very specific that I want to buy a AA bond or a AAA rated bond. Structured products, since there is derivatives in it and there is debt in it, ratings actually is not a very, very important aspect. So, but having it secured is very important. So whom do you buy it from? There are about 6 to 7 issuers in the country. So it's still a consolidated market, not a very fragmented 6 to 7 issuers. I think domestic issuers, you can have 1 or 2 of them. You can have multinational companies also issuing structured products. So you can have a couple of MNC issuers and a couple of domestic issuers.
Right.
And debt and equity. I think that will be a good mix to have about 4 to 5 different structured products in your portfolio. And very importantly, always buy structured products which are not short-term in nature.
Right.
Always buy the long-term structured products. People generally tend to get lured to buy a structured product which is finishing in a year's time because they don't want to actually put in their monies. It's not a very wise thing to actually buy structured products which are less than a 3-year time frame.
Right. Feroze, one more question I had was when you talk about the aggressive category of the structured products, does that automatically mean that the risk level goes up when you're talking about the kind of credit risk that you're taking?
No, the credit risk actually is agnostic to your market view.
Okay.
So if you take a principal protected product or non-principal protected product, your credit risk remains identical. One thing which changes is the tax element.
Okay.
Okay, the taxation on a non-principal protected product is going to be 20% on a 3-year basis. So it does not become long-term after 1 year. But a principal protected structure, since it's principal protected, SEBI allows it to be listed on the exchange. That makes it 1 year long-term, and the taxation is 10%. So principal protected have a tax advantage. But coming back to your question of whether the credit risk actually differs between these two, no.
Okay.
But taxation certainly does.
All right, Feroze, we'll leave it there. Thanks very much for joining
Thank you so much, Avani.
With that, it's a wrap on this episode of Wealth Manager. To catch expert opinion and views on how to make your money work for you, log on to btvin.com/wealthmanager. If you have any queries or comments, do write into us on wealthmanager@btvin.com. Here's wishing all our viewers a very happy Dashera. Thanks for watching.